I've never really understood the stock market, and for most of my life, I thought it would take too much time to learn, even though I knew that one secret of becoming rich was to spend my money buying assets like stocks that make you money over time, and spend less on buying liabilities that cost you money over time. I'll admit that I spent way too much on liabilities that required a continued investment in order to maintain, repair, or replace them. Those were things like boats, RVs, ATVs, and UTVs, luxury vehicles, pricey electronics, and other trendy novelties. I tried to be a minimalist in order to limit my liabilities, and I routinely invested in my employer's retirement plans because it was the only way I understood how to build assets, but I wasn't really committed to building wealth. When I started working as a sole proprietor, I had to set up my own retirement account. And to my horror, I realized that instead of handing over money to be invested on my behalf, I actually had to understand how the stock market worked in order to make sound financial decisions about my retirement funds. And so my research project began. I quickly realized that investing is incredibly interesting, and it's a surprisingly easy game of numbers. I don't want a single person to miss out on what I've learned. I'm going to get you up to speed in less than 10 minutes. Buckle in, baby. We're taking a ride. The very first company in recorded history to sell stock was the Dutch East India Company, which was basically a huge company that shipped goods all around the world in the 1600s. In order to minimize the financial burden of one investor losing a ship at sea, thus losing all his money, the company sold shares of a ship to many individuals, so that if the ship and all of its goods was destroyed, a lot of people each lost a little bit of money. But if the ship made it safely, then each of them would gain a little bit of money. Many investors would buy shares of multiple ships in order to offset the few shares that would take a loss. This is the same investment strategy we use today, and it's called a mutual fund. Of course, our modern stock market is much more complex, but it's still based on a few very simple ideas. First, you've probably heard of the New York Stock Exchange. But do you really know what it is and what it does? I didn't. It's basically the vendor that handles the transactions between companies who need money, and thus are selling stocks and bonds, and the investors who are willing to hand over the money in the hopes of a profit. There are many different exchanges in the world, but the New York Stock Exchange is the largest in the world, so that's the one you've heard of. You've probably also heard of the NASDAQ, too, because it's the second largest exchange, and both of them are American stock exchanges. You've also probably heard the nightly news report the Dow Jones Industrial Average, or the S&P 500. But what in the hell do these numbers mean? They're called indexes, and they basically tell you how a certain subset of top-performing companies are doing financially. For example, the S&P 500 analyzes the financial wellness of the top 500 companies in the United States. It does some math and averages the company's business doings into a number. So if the number goes up, people can assume that the majority of businesses and their profitability is increasing, and vice versa. So now, what is a stock and what is a bond? We'll start with the easy one. A bond is a loan. So if a company or the government needs to fund a large project, they don't ask the bank for a loan like you and me. Instead, they issue bonds that guarantee a certain percentage return. A bond means a company promises to return your money plus interest to you within a certain amount of time. Basically, you're acting as a bank and giving them a loan. Bonds are very safe, but that means they aren't that profitable. And for a gambler, they aren't much fun either. Stocks are a whole nother ballgame. When a company issues stocks and someone buys a stock, the buyer becomes a partial owner of that company. In other words, they own a share of that company. They aren't guaranteed anything, not their original investment or any profit. In fact, they won't ever get their money back unless they are able to sell that share to someone else who wants it. Companies issue stock for the primary reason of raising capital that they never have to pay back. Investors buy stock in the hopes that in the future, someone else will want to buy it for a higher price. It's important to note that companies only get money when they first sell their stock. They don't profit at all when their stock price increases. And they don't lose money when their stock loses value. Also, People who own shares don't necessarily profit when a company grows. I know, this is all very confusing. Let me lay it out to you nice and neat. So we have this company, and the company needs money, so they decide to sell shares of their company. The company can choose to sell one of two types of stocks. One that pays dividends, which is basically the company being nice and sharing a percentage of their profits with the investors. And of course, this is very desirable for an investor. It means he can recapture some of his initial investment. But there are also shares that do not pay dividends. And either way, there will be people who like the company and buy the shares in the hopes that someone else will want to buy them later at a higher price. This is when the gambling starts. Some people say the stock market isn't really gambling. Bullshit. It's a game. Trust me. In reality, stock prices rise and fall only because people are playing the game. A stock price doesn't go up because a business is doing good. It goes up because other investors place it at a higher value since the company is doing good. You see what I mean? Although a company is not financially affected by their own stock price, they do get free advertising when their stock is mentioned on the news, and they can build a positive reputation that can attract other investors. So they do have a vested interest in their stock value. I just wanted to point out that they aren't profiting or losing based on their stock price. I had always assumed they did, and I'm sure others have that same misunderstanding, so I wanted to be sure that was clear. I think the confusion is that many people who run a business have also invested significantly in the business by buying shares. So when a company loses value, frequently so do the owners and the employees because they too have invested in buying shares of that company. So anyway, the rules of the game go something like this. Everyone wants to own a share of successful companies, and they do not want to be affiliated with failing companies. These desires are what fuel the rise and fall of stock prices. Now, playing this sort of game requires constant effort and business smarts. And it's risky, and certainly absolutely not for beginners like you and me. But don't worry, you have other options. Before I continue, let me clear something up because you're probably waiting for me to start throwing around terms like technical trading, hedge funds, limit orders, futures, blah, blah, blah. I assure you that in order to invest in the stock market, you do not need to understand all that crap. You only need to understand 3 things: market order, buy and hold, and index funds. A market order is when you buy an investment like stocks, bonds, or mutual funds at the going rate. And that's what you're going to do. As you learn more, you might want to try a limit or a stop order, but we aren't covering those in this video. Next, you'll be following the buy and hold strategy, which is an investment strategy in which you buy and then hold onto whatever you've bought for a really, really long time. You aren't following stocks, trying to predict the market, or basically gambling, always hoping to buy low and sell high. You're in it for the long haul, which is a low-risk, practically guaranteed method for success. You'll be investing in a mutual fund. A mutual fund is a basket or collection of stocks and bonds that allow you to invest a little bit of money in a whole lot of things, which allows you to offset any losses. There is one kind in particular called an index fund, which has proven to be most profitable for a buy and hold strategy like you're going to do. An index fund is a collection of stocks from companies who are reported on a particular index. And since the company is used for an index, it's usually high quality and it's going to increase in value. So for example, the Vanguard S&P 500 Index Fund invests only in the top 500 companies that are reported on the S&P 500 index. Every year, the fund adjusts their holdings to account for changes like the loss or gain of a company on the index. These types of mutual funds might also be called ETF funds or exchange-traded funds. The long and short of it is that an index fund pretty much ensures a successful return as long as you're willing to buy and hold for a long period of time. So you're ready to start investing? Great! But first, Be sure you've paid down your high-interest debt. Even if you invested in an index fund and gained a hefty return on your investment, you're just losing it back to the interest you're paying on that debt. Deal with your debt first, which, by the way, does not include your home. Next, you'll have to actually save up cash to invest. I know, that's the hard part. Finally, before you invest in anything, be sure you've invested in yourself. The time you spend in your career will pay you the best dividends, so invest in your education. Any successful investor will tell you that there is no better, higher yielding investment than your own time. Okay, so let's say you're ready to go and you've got some cash in your pocket. Perfect. Let me show you around the Charles Schwab website. Just so you know, I am not affiliated with them in any way. It's the investment site that I used, and it's the one that I know about. I'm sure there's others that are just as good. So first, you need to create your account at schwab.com. That's the easy part. Creating an account with Charles Schwab simply means you've registered to use their website. You haven't actually created an investment account yet. That's what you need to do next. Go to Accounts, Open Account. If you're a beginner, you'll start with either an individual brokerage account or a retirement account. An individual brokerage account just means you're here to play around and invest some money. A retirement account is different. There are basically 3 types of retirement accounts here. First, you're either transferring funds from an existing retirement account you have somewhere else, or you're starting from scratch. If you're starting from scratch, you have 2 options, a Roth or a traditional retirement account. These are pretty much the same thing, there's just one slight difference. First, they're the same because as of 2021, you can only invest $6,000 into these accounts each year. You will actually be penalized for adding more than that. Now, a Roth IRA requires that you pay normal income taxes on your investment, and then you'll withdraw it tax-free when you retire. A traditional IRA is the opposite. You don't have to pay taxes now, so you can reduce your taxable income this year, but you'll be taxed later when you withdraw it into retirement. Your choice between one or the other depends on whether you think your tax bracket will be higher or lower when you retire. And by the way, you can have both types of accounts, but you are still limited to the $6,000 total contribution between each account each year. In other words, you can't fund them both to $6,000 a year without incurring a penalty. Okay, so you've set up your account. Now you need to link an account that you'll use to transfer money into your investment account. So go to Account, Transfers and Payments, External Accounts, and link your account, which will typically be a bank account. Once the account is linked, you'll need to transfer money into your brokerage or retirement account so you can start investing. Go to Accounts, Transfers and Payments, and then Online Transfer. Now for the fun part, choosing how to invest that money. You can do your own research or you can let Charles Schwab help you out. I'm going to focus on the easiest method that doesn't require you to do much thinking. But just so you know, in case you want to take things into your own hands, you can use the Research or Trade tab to look up different stocks, mutual funds, and bonds, and from either of those tabs, you can enter the purchase flow to make your trade. Now, let me show you that purchase flow for getting you started with making trades. Go to Research, Mutual Funds, Mutual Fund Portfolios. If you have more than one investment account, you'll need to select which account you want to build this in and click Continue. Next, choose Exchange Traded Funds and Continue. Then you'll be asked about your risk tolerance. If you're young, you can tolerate more risk. Click Continue. Now, you'll have to decide how much of the money you transferred into your account will be used in this particular trade. Click View Result. Now you'll have to select which funds you want to invest in from 4 categories: large cap, small cap, international, and fixed bonds. Then click Trade. You'll be shown a summary of your trade, and you'll click Trade once again. You'll get a pop-up asking you about the details of your trade. I would recommend that you research the other options simply so you're informed, but for now, I'll tell you the exact choices you need to make as a beginner. Select market order, choose to reinvest dividends, and choose good until canceled. Click Continue. You'll then be asked to review and confirm your order. If you don't have enough funds, or if a fund requires a minimum investment, you might be told there's an error. And you're done. When another investor is ready to sell, you'll automatically make the purchase and Charles Schwab will send you an email to let you know. If you want to check your accounts, go to Account, Summary to see an overall view of all your accounts. You can scroll down to view individual accounts. And that's all there is to it. Now that I've taught you how the stock market works and how to set up an investment account with Charles Schwab, you're ready to get started. Good luck with your investments. This is just the beginning.